Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, June 28th, 5:38 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're flipped back to correction. The fledgling rally that started last week suffered a severe distribution day. Today, leaders or fledgling leaders really got hit hard also. And that's it. That's very typical of what happens during bear markets. They rally strongly off the lows, they run into resistance, and they fail. And we got longer yesterday, right around the 21-day exponential moving average. But as part of the plan, we knew they were low risk entries, and if we broke below, which we did earlier in the morning today, we had plans. We had our stop set. We exited and in fact flipped net short by the end of the day. Check the trend gauge over here. We had some hope that leadership and the short-term moving averages, we had them green sub arrows pointing toward at least neutral, but that's over after today. We're back to max bearish, meaning leaders are in a downtrend, and with the break of back below the 21-day exponential moving average across the indexes, we are short-term bearish, medium-term 50-day moving average never got back above that. So that's bearish also, in long term, still well below the 200-day moving average. Discretion is the better part of valor in a bear market. So what happened today? Not a bad open. In fact, we opened green and then we rallied strongly for about the first maybe 20, 30 minutes, but that was it. We completely flipped. Trend down day, closed near the lows of the day, worst possible case scenario after a follow through day, worst possible case scenario for the bulls, kills the rally. G6, that's our growth index, minus 2.6%, S&P down 2%, NASDAQ 100 down over 3%, Dow Jones Industrial Average down 1.6, mid-caps down 1.4, Russell down 1.9, diversified global 60/40 stock and bond down 0.9%, in-house down 0.52%. We're still positive versus the last time we went to cash. So from this cycle, last time that we were in cash and then going long and then flipping back to being in all cash or net short, we're still slightly green from that exercise. So our step in, step out process did its job. We'll go to the tail of the tape and then review the charts in a second. But first, let's review the team here at Revere. Trend following is what we do. When you think about it, you follow trends in your life. Why should your investments be any different? It just kind of makes sense. That's the way we look at it. What part of your life, when it's going bad, do you not take corrective action? We feel that investments are the same way. So when the market's fine, acting fine, in an uptrend, we use technical analysis to identify this. We participate in that. When the market stops going up, starts going sideways, we pull back a little bit. When the market rolls over and goes down, we get the heck out of the way. And if you're interested in this approach, give us a shout. You can email any of us, Dan, Tim, Hunter, Mural, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's bring up the tail of the tape. Back to correction, as you can see, headwinds continue, and this is really why we are in a bear market. When the macro and the technicals line up, and that's really what's happening. The Fed is not helping right now. The Fed juiced the big rally after COVID. But now we've got a strong dollar. We've got inflation as a result of what the Fed did. The Fed is pulling back, reducing their balance sheet, raising interest rates. And then, of course, we got Russia, Ukraine leftover supply chain issues from COVID, but all of these things leaning on the market, and the market will bottom before things will look better. So we're always on the lookout for signs of bottoming. We've had several attempts at rallies since we topped right at the beginning of the year, but they've all failed, and it's a bear market until proven otherwise. So back to the bear today. Put call about 1.0 can go a lot higher before we find a bottom. Same thing with the VIX at 28.4 and the fear and greed index at 26. Those really show no signs from a sentiment standpoint that a bottom is in, and that's supported by the action today. So the bull case is dead. Failed today, 628. Back to the bear case. Rally failure and break of 21. Check. Bear case in effect. Some news today, consumer confidence hit a 16-month low, and consumer forward-looking expectations hit a 10-year low. So you certainly don't have any optimism on the part of the consumer, and the consumer really drives the economy. So if the consumer's pulling back, are we in a recession? I don't know. We get the final Q1 GDP data numbers tomorrow. That'll be interesting to see if they've been revised. But back to the markets, what we were watching coming into today was this support area that held yesterday, this 3890, 3900, but it just got banged on so many times yesterday that when it got hit again today, we just busted right through it, decisively broken to the downside. So now we look for our next level of support, which we show below in the tail of the tape. As I said, gap up 0.4%, and we rallied very quickly up 1.2%. Went sideways till about 10 a.m. and then we just broke down and just had a severe trend lower. So on the daily review of the S&P 500 here, you can see above the 21, above the last 2 days highs, and then a big rollover, break the 21 decisively. In fact, we broke the 80 MA, and the 21 rolled back over after flattening out over the last 2 days of actions. Let's take a look at a 5-minute chart here. You can see, so here's Thursday's rally. That's the follow-through day. Here's Friday, where we kind of consolidated near the top, which was good. Here's this morning's gap up and a really quick run up to this 39.45 before we went sideways a little bit, couldn't go any higher. Then we started to roll over, found support near the lows of the open around this 39.15-ish level, but then that broke and we had just one leg down, a little reprieve, another leg down, a little reprieve, and then just kind of sideways into the closing at this 38.20 area. So we're back below the lows of the gap up day. Let's pull this out a little bit. Here's a 15-minute chart. You can see this big gap up from Thursday. This cup ended Wednesday. So this 3800 area is going to be our next level of support when we get down in there, and we're pretty close to it. Wouldn't be surprised to see a bounce there. That's a 15-minute chart. Let's go out to a 30-minute chart. You can see this 3800 area has been a battleground from the last leg down of the bear market. Tried to get back above it, but couldn't. Tried to get back above it here, June 21st, 22nd, 23rd. Then we finally gapped above it, but we've given all that goodwill back. 3800 is the next area that we want to keep an eye on for support, which was really this area that we broke out of on Thursday. Back to the tail of the tape. The Qs filled their 623 gap and broke below it. We haven't quite filled the gap on the S&P 500. Let's take a look at the QQQ here. You can see this looks worse. Here's the gap up. We filled that gap, so we're back into that range also. I also mentioned GDP final Q1 data tomorrow, and then big CPI report on Friday. Oils and fertilizers. Oils, second straight nice up day. Fertilizers with a bounce, but 10 out of 11 of the broad sectors, the S&P sectors, were down. Particularly hit hard were the Chucky, CKY. That's communications, technology, and discretionary software, which had been bouncing very nicely, really with a harsh reversal, down 3.7%, and biotech, which also people have been putting money into, down 3.6%. Retail also had a bad day today. So what do we do from our portfolios in-house? Well, the plan was, let me bring up, where is this chart? Let me find it. Okay, here we go. So I shared this with the fellas yesterday, and basically I was looking at what were the low risk entries that provided some good payoff for the associated risk reward, and I highlighted the good in green, and really it was when we were breaking back above the 21-day moving average or the 200-day moving average, or failing at the 21 or the 200. So this gave us we didn't take all of these, we did at some point, but the idea is to get in as close to the proper risk reward level as possible. So here a breakdown of the fail of the 200, here a breakdown of this level below 4,400, here a failure of a rally up into the declining 21. The pink areas to get short, to get long here, back above the 21 on this last move off of the bottom. But when that last move failed and we broke down after the Fed, that was a good area for a short, low risk short, a whoosh down. And now we broke off of the bottom, and I had this highlighted in green, and that's why we got right at the 21. We had a good opportunity to get low risk entries there, because if it failed, this green dot is just going to be replaced with a pink dot. And that is exactly what we saw here today with the break back below the 200-day moving average. So the first plan was our SPLG long, which we were up about 4% on. If that would have broken the 21-day exponential moving average, we were going to get out, and we got out of that fairly early this morning. So when we broke back below this 3,900 area, let's go back to a 5-minute chart here on the S&P. So this 3,900 break here, when we broke back below the 21, this is when we got rid of SPLG. Then we started failing further down. Let's go to the QQQ. That put us back below the 21 on a daily on the Qs. And we sold our 15% position in the Qs for about a 1.5% loss. The next order of things to do was, what did we want to do relative to our VOO, another S&P 500 long position, if we could not bounce and get back above the 21-day exponential moving average. And really, once we broke it, we just held there for a few minutes. This is the 3,900 area here, right around this area. And when we broke down from there, we put a hedge on. This was SDS. So this effectively lets us do two things. It gets us flat because we broke back below the 21. But if we would recover by the end of the day, it gives us the option to reduce the hedge and stick with the long. But what happened was we continued to go lower, had a little bit of a bounce, and then we broke the lows, these prior lows of the day. And when those lows broke, we got rid of our 20% VOO position, which left us just with Zoom as a long. And what did Zoom do? Zoom broke below this 116 area, which had been acting as support. If we look at a 30-minute chart, this 116-ish area, once we broke back below there, we closed our Zoom position. So those were the trades for the day. Sold our 10% SPLG, sold our 15% QQQ, put on this 10% SDS, which basically neutralizes 20% VOO. We kept going lower, so we dropped that, and then our stop was hit on our 6% Zoom. We're still holding this 10% SDS position, so we went from a volatility adjusted beta of positive 0.66, so basically 2/3 of the S&P 500, to a net negative by the end of the day, net short by 20% versus the S&P 500. Because of our position size, 10% SDS is equivalent to 20% inverse SPY short. So down 20%, we're still holding our 5% GLD position, which is really not making much progress, but it is showing some relative strength versus the indexes. Still holding on to this. We're down about 2% on this. Really hasn't done a whole lot. Had this faked breakout, had a fake breakdown. Still holding on to this. And then we've got 10% in VTIP, which is our short-term inflation protected bond. So exposure down. We're basically net negative, net short by 20% versus the S&P 500. The bottom line, as I said, big outside negative reversal kills the rally. We're down here at 38.22. There's a big area of support here between this 38.15 and 38.55, which we're right in the middle of it. But then the next level down, as I'm going to update this for tomorrow, is below this 3,800 level, which I pointed out in the S&P 500 chart, is this next level of support down based on the way things have been acted over the last 2 weeks. So let's go to the Dow Jones Industrial Average now, take a look at that index chart, and same thing, pop to the upside, outside negative reversal to the downside, breaking below the 21. Mid caps above the 21 early in the day, gave it up, closed right on the ADMA, another outside negative reversal, and to make it complete, here's the small caps above the 21, outside negative reversal back below the 21. We really key on the 21-day exponential moving average for our short-term indicator. When we get below there, we want to really back off, especially when we're below there and below the 50 and below the 200. And that's pretty much it. Let's take a look at a few of the 21 over 21 that got hit hard today. I said leaders, we had a sub arrow that was pointing towards neutral. Well, that green sub arrow is gone. Still holding above the 21 for some of these, but you can see some things that acted well had really bad days today. So prospective leaders got hit hard. Chewy down 7.6%, still above the 21. Enphase, hard negative reversal, down 7.5%, sitting right on the 21. UiPath still above the 21. Zoom, I said we got stopped out on there. That's sitting right on the 21. Celsius, negative reversal at the 200-day moving average, but still above the 21. GTLB, negative reversal, down 4.3%, still above the 21. VRTX, this was a leader, hard reversal, down 4%, still above the 21. Ulta broke the 50 and the 21, sitting on the 200. Monster Beverage, still above the 21. Lantheus was really looking good yesterday. Some volume came into it, followed through to the upside, broke back below the 21 and the 50. So sample there of some things that got hit hard within the 21 over 21, still holding, quite a few of them still holding above the 21. We'll see what the rest of the week brings. But with the indexes below their 21-day, now declining, moving average back below them, below the 50, below the 200, rally over, we're back to net negative. And we've got a plan as far as this holding this short. If we get 5 to 6% below the 21-day moving average, we'll exit it because that's kind of extending the rubber band for a snapback. Alternatively, if we trickle back up to this declining 21 and fail there and start to roll over again, we may add to it. So that's the plan for that. As for now, rally dead. Let's see how some of the things that are in the 21-21 hold up, but we really don't have any intention of getting long when stocks are not cooperating. The indexes are not cooperating because stocks, 75% of them will follow what the indexes are doing. And that's going to wrap it. So ending, as always, like feedback from me, you can email me, don@revereasset.com, or phone 855-REAL-WEALTH. So wrapping up a terrible Tuesday, June 28th, this is Don Vandenbord reminding you, it's not how much you make, it's how much you keep. That's the fact. That's why we have the discipline we have at Revere. It doesn't matter if you say I was up 30% last year. If you're down 20% this year, you basically gave back what you earned. And there's a better way. And if you're interested, contact us. Thanks for listening and have a great day.